All right, guys, we're back again with another episode of PFREI. I'm your host, Fuquan Bilal. Let's get ready for a great conversation with Graham Parham. I'll just give you a quick introduction, Graham. So Graham has been a mortgage loan officer for about 24 years. His experience in the residential market has developed a significant following among home buyers and investors. He's known and respected industry-wide, and Graham's production consistently ranks him as tops here, 1% nationally. And you can speak a little bit more about that. Graham's often valuable insight to a purchaser's likely requirements, providing exceptional business ethic, customer service, and respect. Um, it's a lot here. It's a lot here. We'll dig into it. He's truly a dedicated person who strives to ensure that each transaction is handled in a timely and stress-free manner. By deploying these standards, Graham has established a solid reputation. So, you're an active investor. You also are in the mortgage business, which really kind of wanted to have you on a show to kind of talk about the climate with interest rates increasing. I know you don't have a crystal ball, but we'll talk about some of what you see from your experience over the last 24 years, where this thing is going, and also how is it affecting your business. But before we get into that, I have one question I always ask the guests. Why are you passionate for real estate investing?
Well, I got into mortgage lending 25 years ago, as you say. And when I started seeing tax returns come across my desk for some of these larger investors, and I start trying to think, what do these guys know that I don't know? Nothing. They're just doing it. So I jumped in about 18 years ago, bought my first property sight unseen from one of my investors. And it was fairly easy. And then I ended up buying 8 the rest of the year. And I felt, this is the way to, secure your retirement and passive income. And it's been that way ever since. So, I'm coming up on 50 properties now, and these are all single family, 1 to 4 units. And I don't do much in commercial or anything of that nature. I stick with the single family stuff. So they're scattered all over the U.S. I've got several properties coming off the ground in Florida right now, which none of them got hurt too bad by the hurricane, but it's all good. So that's why I got into it. I think it's the way to go. And it helps me in my job, especially because all I do is work with investors and provide loans for them. So they get 2 hats. They got one as a loan officer that all he does is work with investors, but they also get an investor. And as an investor, I can give them my opinion only. And that helps a lot of times. It gives them a little bit of peace of mind.
Interesting. Yeah. So it sounds like you're just alternative investments. No Bitcoin. Come on, man.
No, I don't. I stay in the lane that I know. Okay, and I know real estate, and I know mortgages, but I don't. The Bitcoin, I know people have had a lot of success in it, and I think it's great. I just I got to focus my efforts on what I know.
Absolutely, absolutely. Let's jump into the marketplace now. I mean, we're now in fourth quarter of 2022. It's a fabulous Friday, by the way, in November. And I kind of want to get your take on it. I mean, you've been in long enough, 25 years, you say. For me, it's been 23 years. So that means we both are market cycle tested. You've been through 2008 and everything else. What do you kind of see? Like, what does it feel like to you now? Does it remind you of the market before? Do you see any indicators? Once we start seeing in the news, we know that's late news. We're on the front line. Tell us what you're seeing and how you're transitioning through this period.
Well, the '08 bust, it was a little different from where we are now. The wheels came completely off. People didn't even know if they even wanted to provide loans. They throttled back, Fannie Mae and Freddie Mac, they throttled back, and everybody else throttled back. All the Alt-A paper or the non-QM paper, they left the playing field. So it was scary there for a year or so. This is different, okay? The feds are running the show. We got hit with another rate increase this week, okay? And so we're clearly in the 7s and trying to push that 8 ceiling. And that has an effect on, obviously, people purchasing real estate, to get their cash flows and if it makes sense. But the seasoned real estate agents, or the seasoned real estate investors, should I say, like myself, they recognize that the inventory is starting to come out there because we've been, dealing with a little bit of inventory. So now we're starting to accumulate inventory. This is a good opportunity to buy. Okay. So you marry the property and you date the rate, because what we're going to experience is that, the Feds are going to push us into a recession. It's clear that's going to happen. It's cyclical. It happened back in the 80s and 90s. It happened with Greenspan, and it's happening with this knucklehead. So, we're going to go into the recession. When that happens, the rates will come back down. That's when you'll be back on my doorstep a year from now, giving you that 5 or 6% interest rate versus, the 7 or 8s. So that's what I know. And Wall Street recognizes this. Okay. And here's the other challenging part about in the Fannie Mae world and the most of the worlds, in most of the lending worlds, the Wall Street's buying these mortgage-backed securities from, Fannie Mae and Freddie Mac at a much higher note rate than they have like during COVID. COVID rates were just ridiculously cheap. But, the investors were buying notes back, 17, 18, and 19. And all of a sudden, here comes COVID. They dropped the bottom. Everybody and their mother refinanced everything they possibly could. But the investors, when they bought these mortgage-backed securities, they want to keep them on their books for 3 to 5 years so they can make some money. Well, when they get a thing called early payoff, which is what they experience, well, they lose money. So consequently, what we're seeing right now is that the investors that are buying these notes, they don't want to give as much juice, or should I say enough margin in the rate to make it attractive. In other words, I can still give you the 7.5% rate, but it may cost you a couple of points. Whereas before you could get it for 0 points, but at it for 25 years. I've always had 0 point pricing available up until like 6 months ago. Wall Street just doesn't want to give it to us. So that's our challenge.
Yeah. So how are you transitioning? So I like what you said to marry the property and date the rate. I actually took that note down. I like that. So, I mean, it's true, right? And actually, a lot of people ask me because I do a lot of ground up stuff also. Hey, you got to be careful with that. It's risky. You're dealing because these properties where I'm at in New Jersey, these are million plus, 1.5 million properties. So we know before that market, that jumbo market got crushed, right?
Right.
But we have a huge migration coming in from New York, and $1 million property is pennies to these guys. They have a 2-bedroom apartment for $1 million, so or a condo or something. But these guys have more cash to put up, and they get because they have great credit, better rates, not what it used to be months ago. But how are you guys transitioning into that, providing loans for people with charging points now? Are you seeing it slow down, those loan applications, those new home purchase applications slow down? And how are you encouraging the buyers? Are you saying, hey, marry the property, date the rate, come back to me when it go down?
Yeah, pretty much. Once again, the novice or the people that are just now getting into it, and I deal a lot with a first time investor because in the Fannie Mae Freddie Mac world, I can only provide loans up to no more than 10 loans per borrower. So you're usually starting out, and the fact that I'm an investor and I explain what I'm doing and so forth, so they get excited. And yeah, the brand new ones, they just kind of get they're scared. They're sitting on the fence. But the smart ones are recognizing, like I said, they're marrying the property and dating the rate because they know they're going to have that cash flow later. But the investment itself is still a good investment. If they recognize that up front, and that's not only my job to explain to them, but it's also the providers that selling these properties, because I do a lot of with turnkey providers all over the country. And yeah, I mean, they're getting the inventory, but their margins are getting a little bit more narrow because they're trying to sell these properties and they're giving up some concessions, like 2 point concessions to make it work to help the buyer. They're coming up with, okay, we're going to waive management fees for like a year to get the buyer to buy. So they're getting creative. Okay. Has the market slowed? Yes, it's slowed in all aspects, not only investing, but also known rock. Okay. There's a lot of people that still, don't want to get out and buy that property yet because, oh, that rate's too scary, but they need to look at the dollars and cents. Rate's important, but dollars and cents is still the most important thing. And when they recognize, okay, is my payment at 7% going to be this, or is it 6% is going to be that? Oh, well, that's not that big a difference. Okay. So that's kind of the training, and that's kind of the script we go through every day, explaining what I just explained to you. Wall Street's getting greedy. They want to be, protect their interest, but there's still a good time to buy.
Yeah, it's almost like a seesaw, right? So you have when it was no inventory, rates were super low, you had an abundance of buyers out looking for product, couldn't find it, frustrated. Now you see more product coming to the market and it's less buyers, right? With higher interest rates. So it's like a seesaw. So like you said, this is a great opportunity for that smart investor to buy like when it's blood in the street, right? When it's
Right.
not going after when your next door neighbor, as they say, I'm in real estate. That's when you need to go, oh, I gotta watch what's happening because everybody's into it now. So now everybody's running away from it. Seasoned investors are running towards it,
Well,
knowing that the time will navigate things. Go ahead.
well, like you were talking about, what's the difference between '08 and now? 08, the bottom dropped off the market, and in East Coast and West Coast, they just plummeted. Okay. We're not seeing that yet. Are we seeing some declines in pricings out there? Of course, not much, but we're seeing a little bit. But real estate as a whole during recessionary usually stays pretty strong. Okay. That's a good thing. Okay. Are the rates kind of giving you a little bit more challenging? Yeah, but these not going to last. These are temporary.
Yeah, yeah. Now, like I said earlier in the beginning of the call, I know you don't have a crystal ball, but from your experience, I'm hearing people say, "Oh, the end of Q2, we should, Q1, we should start seeing rates go back down." Or, I know they have like these national calls where you guys get behind the scene and you're dealing with the banks who's providing the paper, who you might be selling paper to or whatever. Most of the fund managers are the guys who raise capital and sell off the debt. Like you have your Lima Ones, the DLPs, all of those guys. That kind of securitized paper and sell it off. There's some chatter coming from those channels saying that, at the end of Q1, we should see rates going down. What is your belief? I know you don't have a crystal ball, but from your
I'd,
experience, what do you see?
I'd say it's going to be between Q1 and Q3 or Q1 and Q3. I hope it's going to be in the spring, but my gut says it's probably going to be closer to like May or June. But it is what it is. If we can do it, ride this storm out until then, we'll be fine. I think we're expecting to have one more bump from the Feds in December, and I'm hoping that that's going to be it for a while. We'll see. We're the Fed fund now is right at 4%, which is the highest it's been in since 2007, I think. It's been a while, and so it's going to have to slow the economy down. It's just going to have to. These last 4 years, with all the increase in values, and it was all inflated. They're trying to correct that. That's a good thing, but I don't think they're doing it the right way, to be honest with you.
Yeah, it's accelerated. They got their foot on the gas, like, all the way. And it's definitely, we'll see. I mean, some people are just, ignoring it. We'll see how it affects the economy when Christmas comes around, right? We got another month before people are going to start buying gifts after Black Friday. We'll see, if those the KPIs for sales on certain things still show the same, or is it going to show its effect in it, right? I'm really looking forward to see how that look, if that's going to cut down shopping and spending, or in the whole, because that affects the whole economy, right? So now real estate is starting to slow down, but it's still the best product. And now we're going to see how retail do, during that time, because if the interest rates drop the bus.
We are still seeing a lot of people grabbing that equity that we've experienced the last 3 or 4 years have been property values going up. I personally am. I got one going down in Florida right now that I'm going to grab some equity and pay off some debt that I have that I don't want next year. So those are still going, but the rate and terms are gone. They vanish because it doesn't even make sense to do it. But there's still people doing the cash outs, taking those equities out and going buying some more properties.
Are you still seeing the no doc programs? That are the no doc programs.
Well, there's not a true stated income program out there. There's for the consumer on the owner occupied side. There's like bank statement loans. Somebody that has a business, they're 1099 and they get a lot of cash influx, but they write off everything on their tax returns. What I personally do is I'm in the DSCR world, which they underwrite the property. If you're familiar with that whole terminology, so
Correct.
service.
That servicing. Yep.
Yeah, yeah. So, and the reason why I'm in it because I'm outside the Fannie box, so that's my only choice. But we're starting to do more and more of those DSCR loans because they make sense. When Fannie Mae and Freddie Mac and the CFPB and everything was changed back, in '08 or actually 10, I think it was. They came out with the Dodd-Frank Act, which prohibited interest-only loans, 40-year amortization, neg am, all that stuff. So the non-QM world, which is not Fannie Freddie, are starting to get a little more creative in that area. Matter of fact, I just locked in on one yesterday. It's a 5-year ARM. It's a 40-year AM, but it's 10-year IO. Well, that made sense to me, even though it is a high rate. Yeah.
Yeah. Of course, because you get to, if it's an investment property, get it stabilized before everything starts to increase. So Yeah, this is very interesting. Just one last question for you. For people
Sure.
who are new and who's on the fence about getting in and investing during these times, what words of encouragement can you give them sitting in your seat of 25 years of experience, right? Because it's always easier for us who's been in this space to kind of be able to navigate through it more easier versus somebody who's coming in and like, oh my God, the interest rates are high. I want to stay on the side till they go down. Especially somebody who's seeing 2%, and now it's
Well, that's our biggest problem because, yeah, during COVID, we did see 2%. I just sold my house. I'm moving to a different state, and I'm leaving 2.2% on my interest rate, and I'm having to go to 7 or 8, whatever the case. But it's all about, that's the way it is. I would say look hard at the investment. Don't worry about the rates. Look hard at the investment. Okay. If it's a good buy and you know it's going to be a performing asset, the rents are going to go up, the rates are going to go down. It's a fact.
I love that. Rents are going to go up and rates are going to go down. Yep. Marry the property, date the interest rate. That's good. So I definitely appreciate you. Another great episode of PFREI, a passion for real estate investments. I want to give you an opportunity to plug your website where people can come and find out more information about you. You go ahead and let them know where they can find you at.
Your best bet is call my toll free number, which is 855-326-6802. I'm always available. I'm 24/7. So that's the best way to get a hold of me. If you miss me, leave a message and I will definitely call you back.
And it's Highlands Residential Mortgage Ltd, correct?
Correct.
Awesome. Awesome. All right, guys, another great show, Passion for Real Estate Investments. I'm your host, Fuquan Bilal. Be sure to catch us on all the social media platforms, as well as iTunes and anywhere you can find a podcast. Thanks a lot, Graham. I really appreciate you being on the show, man.
My pleasure.